Let's bring in Vining Sparks Bank and Equity Strategies Director Marty Mosby. Marty, when we saw this huge melt up yesterday, we were saying, is this a turning point for the market or a technical bounce? But it appears to be the latter. What do you think?
Well, we have two forces really causing this volatility. One is the fear of recession. We're a decade past 2008, but it's in everybody's memory. So when they saw the downturn, and we've seen some of the, information about maybe the economy slowing down, investors got very defensive as we went into fall. So that's been the first thing. The second thing is we passed a Volcker rule as we went through the financial reform, and that really took away the ability for market specialists to step into this trading. And so when you get imbalances, you really get much more volatility. So you got the fear of recession and this volatility according to the trading rules, and that's really where we're caught right now.
Should the SEC reinstate the uptick rule, and that would basically help to not compound the losses on the downside if you could only, buy a stock on the uptick, right?
Right. I mean, so there are still things that they could do to clean it up. But really what you need is participants in the market that they are in the market, making the markets, being able to participate and be able to kind of manage the flow of buy and sell. Right now, if somebody wants to sell, the flip side is you got to find a buyer. So even those little things that you're talking about won't make a difference when you have to just say there's nobody in the middle that can step in and put any capital to work. If you got a buyer, you got to go find a seller. And if you got a seller, you go find a buyer. And in periods when the opposite side doesn't want to step in, you just create this drift that we find ourselves in right now.
Yeah. Oil prices are falling again this morning. We saw basically 9% downturn upturn in yesterday's trade. When stocks were up, oil was up too, and now we're seeing a little bit of the reverse. I want to bring in Liz Peek here. What do you make of the wild moves, not just in equities but in commodities too, Liz?
Well, I think we're looking at all these things as sentiment indicators, almost sentiment about the economy going forward. And when people are optimistic, for example, I think the news that the Chinese and Americans are going to be meeting about trade, that obviously creates a little hope that this trade tension is going to dissolve. And that's very positive for everything. It's positive for stocks. It's also positive for oil, because the real oil story is that demand growth is not that strong and supply growth is simply stronger. And so it's created this glut. I think that we all know that could disappear overnight if the Saudis and the Russians decide to cut production. But so far, so many years, we've all watched OPEC try and manage production. It sometimes works and it sometimes doesn't. There isn't a whole lot of confidence in their ability to do so. So, look, it's going to stay volatile. But at this moment, right there today, there's no particular news on oil. I think it really, again, is just more of a sentiment indicator.
It speaks to this volatility that we're seeing all around. And that's not healthy. That's not normal trading. Marty, how does the start of 2019 look to you? Because I thought yesterday we were getting the Santa Claus rally a little bit late. That doesn't seem to be the case. How does 2019 open to you?
Well, we think it'll still see some of this, back and forth at these lower levels. But eventually what we'll see is traction where these two things have to eventually, kind of play out. You're either going into recession or you're not going into recession. If we're not going into recession, then these valuations are too low. Profitability, especially for banks, if you can see profitability continue to move higher while the prices have moved lower, that gap has widened out, and eventually there's a winner and a loser. It just takes time for us to figure out which path we're really on, not just play off perception.
Do you think Wall Street is just trying to talk us into a recession at this point? Because if you look at the data, particularly from the consumer that we got yesterday, where's the recession? Where's the strong economy?
Well, yes, what we call this is the Chicken Little investment thesis, because the sky fell in '08. Ever since then, whenever you felt like it was about to come collapsing back in, you ran inside. But that discipline in itself creates not the recession, it perpetuates this slow growth period that we've been in. And that's where we really think that we're going to see is that as we come out from under this perception and reality, the reality will be like we're seeing now with the Christmas season. The economy still is relatively strong, although slowing modestly.
Liz brought up the meeting that we're hoping for between U.S. officials and Beijing officials. That's a sign that trade tensions are thawing. Bloomberg reporting that a U.S. delegation will travel to China the week of January 7th to hold trade talks with Chinese officials. It will be Washington and Beijing's first face-to-face since President Trump and Xi agreed to that 90-day truce. That was at the G20 summit. Council of Economic Advisors Chairman Kevin Hassett weighing in on the president's trade policies just yesterday.
Well, I think that President Trump has focused on trade reform, and we're making an enormous amount of progress. There's even news today about some movement China's making with tariffs, and I think in the end he wants to reduce tariffs and non-tariff barriers, and he's really making a lot of progress in a short amount of time on that. And I think that's a very big positive for the outlook.
Marty, are you optimistic that he's laying the groundwork for a real deal?
Hopefully. What we'll see here is that both sides have a motivation to make progress, and that at the end of this, like we've seen with the U.S., Mexico, and Canada coming together, like U.S. and Europe, U.S. and China will also be motivated to get things back on track. So we hope this will be positive, and we think that'll be one of the catalysts as this begins to, again, to be able to allow the market to get its footing again.
Marty, hi, James Freeman with the Wall Street Journal. Speaking of Kevin Hassett, most of that rally yesterday happened after he said that Fed Chairman Jay Powell was 100% secure in his job. Do you think that was the reason, or are we blaming the algorithms, or investors just realizing the economy's not that bad?
Well, I think we had a couple of things. You had good holiday sale number coming in. You had, Treasury Secretary Mnuchin talking about the banks and their liquidity and ability to still fund the growth in the economy, which is exactly the case. The banks have 3 times more liquidity than they had in 2008. So a financial type of crisis like we saw back then is really not possible given everything that we've seen in the improvements in the bigger banks that we've been through. So there's several elements that led up to yesterday. And we think all that combination is what drove it up at that point.
But nothing changed, Marty. The narrative has not changed. We don't have a deal with China. We don't have a solution to the government shutdown. We knew the consumer was strong. We knew consumer spending would be strong over the holiday season. We didn't know, but we thought that Jay Powell would stay on as head of the Fed. Was that enough to really move the market over 1,000 points to the upside? I think we're searching for a catalyst, and then also a reason for the pullback again today.
Well, again, we got to take Monday's trading with Wednesday and then put what you're showing this morning. We're net basically all the same we were at Friday of last week. So this is all volatility. We're not talking about a catalyst that's actually solved the issue. This debate is not over. We're going to have this debate going into 2019.
Marty,
it's recession or not recession, and then
banks,
what the end result is going to be the matter.
Marty, why are banks down so much if they're so safe now with the stress test? What are investors worried about here with these banks? They're not in the position they were in 2008. Is there something we don't know about that's going on that investors are worried about?
No, there's nothing you don't worry about in the fundamentals. Fundamentals have continued to improve, but that's not what they're trading on. They're trading on perception in 2008. If you were an investor in banks in 2008, you lost a lot of money, and that was detrimental to your career and your position in the sense of what you were doing in your portfolios. Nobody wants to be there when that happens again. When you look at banks, if you go into a recession, they're going to be down another 25 to 30% from here. If we don't go into recession and we have a base case, they're going to be up 30%. So we have a very dichotomous answer depending on what path we go down, and that's really what investors are trading on, depending on where they tend to go sway back and forth in this recession debate.
All right, Marty Mosby, thank you for coming on.